What do you do when you see the world's priciest stock market? Well, of course, you jump in. You came here for the truth, so let me unveil that for you. Today we're going to look at the world's most pricey stock market. Let's begin. I need to begin with the CAPE ratio. The CAPE has nothing to do with Batman and Superman, I assure you. What we are talking about is the cyclically adjusted price earnings ratio. All right. Now, Robert Shiller is known for this. He developed it here with John Campbell. And essentially, we are looking at these price earnings ratio. You've probably heard of the PE ratio before. But this here takes into account inflation. And that's what's really important here. The CAPE ratio is the real inflation-adjusted price of a share divided by a 10-year average of the real earnings per share. And Barclays actually keeps a tab on all of these. So we're going to look into that today and try to get an understanding of what that means, and then I want to move on to others. Let's consider what these ratios mean. Ownership of stock represents a long-term claim on a company's earnings, which the company can pay to the owners of shares as dividends or reinvest to provide the shareholders more dividends in the future. A share in a company is not just a claim on next year's earnings or on earnings the year after that. Successful companies last for decades, even centuries. Okay, so you're with me so far. Just very quickly, I need to cover this before I go on to the next one. So to arrive at a valuation for a country's stock market, we need to forecast the growth rate of earnings and dividends for an interval considerably longer than a year. We really want to know what the earnings will do over the next 10 or 20 years, but how can one be confident in the long-term forecast of earnings growth across countries? So it goes on there, and this is actually Robert Shiller's words himself. He's writing here in Project Syndicate. And he has this chart that's all calculated out, showing us what the CAPE ratio is. And I want you to check this out if you have a moment. Depending on where you are around the world, you can see the CAPE ratio by country. So I've only selected the US, but you can do so for wherever you are, Canada, China, anywhere else. So that's something interesting for you to note. I didn't want to put too many here because then it would get a little messy. But essentially what we can see is that at the time of the dot-com boom and bust, it hit its peak. And we know that. But over time, since the financial crisis, we have seen these levels increasing in the US stock market. It has happened very quickly in these years, and there really isn't a justification for it. We're talking about a time frame when all of the real economic factors are showing their weakness, but the stock market itself is rising to unnatural levels. Look at the dot-com boom and bust. The stock market looked a lot like this, a real spike upward. And that's okay if it's justified, but the euphoria took hold. And we saw that. We were very, very clear on that. When you look back in the pages of history, you can see, okay, all of these individuals were getting in over their heads. There were people who didn't know anything about stocks, but they were dumping their life savings into it. And oops, oh no, everything came crashing down. What we can see today are similar trends appearing. And I've been showing you those over this past few years, trying to show you how it's become worse and worse and worse. Does that mean that tomorrow is going to crash? Absolutely not. All I'm trying to show you is that when the time comes, it's going to be even worse depending how long it takes for the markets to reverse course and start to correct themselves a bit. If the market would pull back 10 or 20%, start to get a firm footing, and then go and increase again, and do that a few times over the next couple years, that would be very healthy for the economy. But it isn't working like that. If you look at the way the stock market is going, it's basically in a parabolic direction, and that is never a good sign. There always needs to be some sort of correction before it can retrace and go to new highs. That doesn't seem to be happening at all. Look at the US stock market. It doesn't happen at all. Every month after month, it breaks its previous record high. I remember seeing that before. All right. Only 4 largest central bank balance sheets, okay? Not all of them, just the largest 4. Show liquidity is still being pumped into the system. This is from the financial crisis and onward. And guess what? That's right. They're printing. They are printing $20 trillion over the past decade to keep these markets alive. This is new. Central banks wouldn't normally do this at this level, and especially doing so globally. It's never happened like this. Yes, the Bank of Japan has done it, and other central banks have done this before, but never in a concerted effort to destroy the value of all currencies. Clearly, there has been some sort of meeting between all of them to say, look, we all need to act together. Okay, you will do so for the next year, then we'll take over, and then you over there, you take over. And there has been this definite agreement between them all. Surely you've seen the Federal Reserve, 4.5 trillion. That was enough for them. They capped it off right there. They have been quote unquote tapering since October, probably about a crumb compared to the entire balance sheet. But that's their version of tapering, apparently. And then you look around the Bank of Japan, you look at the ECB, I mean, just Swiss National Bank, everybody, the whole party is printing. Trillions and trillions and trillions, 20 trillion at this time. Risk appetite is now at the highest level on record, which leads to questions about future returns. And I don't blame them. The amount of risk that people are willing to take right now is justifiably at an all-time high, because there's no reason, if you take out all the indicators that I've shown you here, there is absolutely no reason why the stock market should go down from here. Doesn't make any sense. You have central banks printing up $20 trillion over the last decade. You have interest rates near record lows globally. Some of them are negative. And you have a general sense that everything is fine. And I would say that within the financial markets, the financial analysts, very, very few are suggesting that things are a little overheated right now. So if we could just ignore the real economy, ignore the people sleeping on the streets, the tent cities and everything else, ignore how many people have 2 and 3 jobs, ignore all that, right? And just look at the financial aspects of it. Forget about the fact that there's a lot of debt there. Let's forget about that. Apparently we owe it to ourselves, therefore it doesn't matter. And you just look at this, risk appetite. I completely agree. The stock market is going to continue higher for the foreseeable future. And we are going to look back on this and realize what had happened. You won't see that now. You won't see that today. They didn't see it during the dot-com boom. They won't see it today, but we're going to look back on it in history. And we're going to say, wow, that was crazy. Now the VIX. The VIX is in itself quite volatile, but when you see the VIX, you have to understand that it correlates oftentimes. In this case here, they're showing the S&P correlating with the VIX, and then as soon as 2018 hit, it just took its own direction, completely dislocating from the S&P. And when you see this type of behavior, you have to start questioning what's going on, what changed. If it's correlating all the time before that, something changed, but we're really not aware of what it is. It's not something very obvious. There wasn't some sort of, big thing that was brought up. Nothing's really changed from December to January. I mean, the market sentiment's the same. All of the same news has really been coming out. So what is it? Well, you tell me. Then we look at this. This isn't the VIX, but it's the VIX term structure, okay? And this is versus the S&P 500, and you will see something very interesting. They're completely correlated every time. You can see that there are dips here, okay? Small dips along the way. But now, since 2018, that same dislocation we are seeing. What's going on? The VIX is acting very strangely, to say the least. And could it be, I'm just going to throw this out there, I'm going to suggest it. Could it be the fact that the Federal Reserve admits to the fact that they short volatility? Are they having their hand in on this? Are they affecting the VIX? They're affecting everything else. This could be in part their decision to do that. Mutual fund liquidity, cash is trash. You've heard that one before. Mutual fund liquidity is at an all-time low. Money market funds assets, long-term funds assets, you can see where that is headed. Cash balance of equity mutual funds. If you look at what's happening in part here, mutual funds are really losing out now because of ETFs. I think that they have lost a lot of market share in this most recent bull market because ETFs are relatively new, and a lot of people, maybe they say, I want to invest in the stock market. They're not really aware of what to do, but they just think, I want to invest in the market. Well, they figured out, maybe they went to their bank and they figured out how to get invested into stocks. And so they bought an index fund. The index fund is going to do the same thing for them like a mutual fund would, except it's going to have lower fees. So they're winning and they have full control over it. That's all they know. I'm investing in a product. It's going to track the market, supposedly, and I would be able to profit from that. And they're doing so. I think the mutual fund companies are really going to be suffering as a result of this in the coming years. As people become more savvy and investing on your own becoming more easy. You can just walk into the bank, they can help you set it up, or you can call the number. They'll set it all up for you. You can put money in there, you can invest, and you can buy into ETFs very easy. You don't have to have any sophistication at all. So that's what's going on. That's a trend. Of course, they're not going to know when to sell, but at least buying into it, that is definitely something that I have seen. Okay, I'll end it there. That's enough ranting for today. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it supports the channel, so I do appreciate that very much. Last but not least, if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. The first book is about the 4 asset classes and how to profit from it, whereas my newer book is about earning income, reducing your monthly expenses, and so much more. You can check those out at the links below. Take care.